In 1923, a loaf of bread in Germany cost 200 billion marks. That is not a typo. 200 billion marks. For bread. And here is the terrifying part, the people who woke up that morning had gone to bed the night before thinking their money was fine. They had savings. They had jobs. They had plans. By lunchtime, those savings couldn't buy a single meal. Welcome back. If you're new here, this channel is about one thing: understanding money at a level most people are never taught. Real explanations, real history, and real strategies you can actually use. Today's topic is one of the most searched, and most misunderstood, financial scenarios on the internet. What happens to your money if the US dollar collapses? Now, let me be clear about what we're talking about. We are not talking about the dollar dropping 5% against the euro. We're talking about a true collapse scenario, a situation where the US dollar loses its status as the world's reserve currency, where hyperinflation sets in, where confidence in the dollar evaporates rapidly. Is this likely? Honestly, I'm going to give you the real answer, not the clickbait answer. The real answer is that a full overnight collapse is unlikely. But a slow, grinding, serious devaluation. That is already happening. And the steps between serious devaluation and collapse are smaller than most people realize. So here's what we're going to cover today. I'm going to break this into 6 major parts. Part 1, what actually causes a dollar collapse, the real mechanics. Part 2, what happens to your bank accounts and cash savings first. Part 3, what happens to debt, your mortgage, car loan, credit cards. Part 4, what happens to your investments, retirement accounts, and stocks. Part 5, what happens to your daily life, jobs, prices, food, services. Part 6, what the financially prepared are doing right now, and what you should do. We are going to go deep on each one. So grab a pen, pause, and take notes, and let's get into it. Part 1, what actually causes a dollar collapse. The foundation, why the dollar has value at all. Before we can understand what happens when the dollar collapses, we need to understand why the dollar has value in the first place, because the answer might surprise you. Before 1971, the US dollar was backed by gold. You could, in theory, exchange your dollars for a fixed amount of gold held in US reserves. That gave the dollar what economists call intrinsic backing, meaning the paper meant something because something real stood behind it. Then, in 1971, President Nixon did something that fundamentally changed the global financial system. He took the United States off the gold standard entirely. From that moment forward, the US dollar became what is called a fiat currency. The word fiat comes from Latin, it means, let it be done. A fiat currency has value because a government says it has value. And because people believe it. That's it. Faith in government decree. So what happens when that faith starts to erode? The 3 collapse triggers. Economists who study currency collapses across history have identified 3 conditions that almost always precede a serious collapse. And here's what should make your ears perk up: the United States currently has all 3. Trigger 1, unsustainable debt to GDP ratio. The United States currently carries over $33 trillion in national debt. Our GDP, the total value of everything the country produces, is roughly $27 trillion. That means our debt to GDP ratio is above 120%. To put that in historical context, most economists consider a ratio above 90% to be a serious danger zone for currency stability. Japan has managed above 200%, but they have unique structural factors. The US. We are in uncharted territory. And here's what makes it worse: the US is currently spending more on interest payments on that debt than it spends on national defense. Think about that for a moment. We are paying more to service our debt than to run our military. Trigger 2, loss of reserve currency status. Since the end of World War II, the US dollar has been the world's reserve currency. That means when Brazil wants to buy oil from Saudi Arabia, they have to convert their money into US dollars to do it. Global trade runs on dollars. That creates a permanent, massive demand for dollars, which keeps the dollar strong regardless of what's happening domestically. But that status is being challenged. BRICS nations, Brazil, Russia, India, China, South Africa, and their new members, have been actively working to de-dollarize global trade. China has been signing bilateral agreements with countries to trade in yuan. Saudi Arabia has floated the idea of accepting yuan for oil. Russia has moved away from the dollar entirely in many of its transactions. If the dollar loses reserve currency status, even partially, the demand for dollars would drop sharply. That means more dollars chasing the same goods. That means inflation. That means devaluation. Trigger 3, monetary expansion without productivity growth. Between 2020 and 2022, the U.S. Federal Reserve printed roughly 80% of all U.S. dollars that have ever existed in American history, in just 2 years. Let that sink in. 80%. In 2 years. When you dramatically increase the supply of something without a corresponding increase in the value it represents, each individual unit becomes worth less. That's not politics. That's mathematics. Now, these 3 triggers don't mean collapse is imminent. But they do mean the foundation is cracking. And understanding that the foundation is cracking is the first step to protecting yourself. History gives us a very clear playbook for what comes next. And we're going to walk through it, applied directly to modern American life. Part 2, what happens to your bank accounts and cash savings? Okay. This is the section most people are actually here for. You've got money sitting in a bank account right now. Maybe a checking account, a savings account, maybe a money market fund. What happens to it? Phase 1, the bank run. Every currency collapse in modern history has begun the same way, with a loss of confidence. Not a loss of money. A loss of confidence in money. When people start to suspect that the value of their currency is deteriorating rapidly, they do something very rational, they try to convert that currency into something that holds value. Real estate. Gold. Foreign currency. Goods. Anything tangible. When enough people do this simultaneously, you get a bank run. And here is the thing most Americans don't realize, the bank doesn't actually have your money sitting in a vault. Banks operate on what's called fractional reserve banking. For every dollar you deposit, the bank is legally allowed to lend out roughly $9. Your money has been lent to someone buying a house, starting a business, buying a car. If even 15 or 20% of depositors tried to withdraw their money at the same time, most banks would be insolvent within days. The government has a backstop for this, it's called the FDIC, the Federal Deposit Insurance Corporation. The FDIC insures deposits up to $250,000 per depositor, per bank. So technically, if your bank fails, you should get your money back up to that limit. But, and this is a critical, but, the FDIC's Deposit Insurance Fund covers roughly 1.3% of all insured deposits. In a full systemic collapse, where multiple major banks fail simultaneously, the FDIC would not have enough money. They would have to be bailed out by the federal government. Which would require the government to either raise taxes, cut spending, or, more likely, print more money. Which would accelerate the very inflation causing the problem in the first place. This is what economists call a doom loop. And understanding it is crucial. Phase 2, your cash becomes worth less, fast. In a true hyperinflationary collapse, cash is the worst thing you can hold. Not because it disappears, your $20 bill is still physically a $20 bill, but because what that $20 bill can buy shrinks daily. In Venezuela's collapse, inflation hit 1,000,000%. That's not a metaphor. 1,000,000% annual inflation. People were getting paid twice a day because if they waited until the end of the day to spend their wages, the money had already lost value. Workers would be photographed carrying stacks of cash in wheelbarrows just to buy groceries. Now, Zimbabwe is the most extreme modern example. At the peak of Zimbabwe's hyperinflation in 2008 and 2009, the government literally printed a $100 trillion bill. Not 100 billion. 100 trillion. And it still wasn't enough to buy a loaf of bread. These are extreme examples. But they follow the same mathematical curve that any serious devaluation follows. It starts slowly, then it accelerates faster than almost anyone predicts. What about interest rates? In a collapse scenario, the Federal Reserve would almost certainly raise interest rates dramatically, as they did in the 1980s when Paul Volcker raised rates to nearly 20% to combat inflation. That sounds good for savers, right? Your savings account starts earning real interest. But here's the problem. If inflation is running at 40% and your savings account is paying 8%, you are still losing 32 cents of purchasing power on every dollar. You're earning interest, but you're getting poorer. High interest rates also crash the housing market, make business loans impossible, and trigger recessions. It's a brutal cure that often makes the patient very sick before they get better. Part 3, what happens to your debt, mortgages, car loans, credit cards? Here's where the conversation gets genuinely interesting, and where a lot of people have a huge misconception. There is a commonly repeated idea in personal finance circles that says, inflation is actually good for people who have debt. The logic goes like this: if you borrowed $100,000 at a fixed rate, and then inflation makes every dollar worth half as much, you're effectively paying back that loan with cheaper dollars. Your debt has been inflated away. And here's the thing, that logic is partially correct. But it's dangerously incomplete. Fixed-rate mortgages, the one case where you win. If you have a fixed-rate mortgage, meaning your interest rate is locked in and doesn't change, a period of inflation can genuinely work in your favor. Your monthly payment stays the same in nominal dollars, but those dollars are worth less. Meanwhile, the value of your home, a real, physical asset, tends to rise with inflation. This is exactly what happened after World War II. Many Americans who had fixed-rate mortgages saw the real cost of their debt effectively shrink as post-war inflation ran at elevated levels. They ended up owning a home free and clear that had appreciated dramatically in dollar terms. So if you have a fixed-rate mortgage at a reasonable interest rate and your home is in a location with genuine demand, in a moderate inflation scenario, you may be in a relatively good position. Notice I said moderate. In a hyperinflationary collapse, the calculus changes entirely. Adjustable rate mortgages and variable rate loans, the danger zone. If you have an adjustable rate mortgage, a home equity line of credit, business loans with variable rates, or significant credit card debt, a collapse scenario becomes genuinely dangerous for you. Here's why. When inflation spikes, the Federal Reserve raises interest rates. When the Fed raises rates, variable rate loans adjust upward. Your monthly payment on that adjustable mortgage could double, triple, or quadruple in a short period of time. During the 2008 financial crisis, which was not a currency collapse but gives us a preview, millions of homeowners who had adjustable rate mortgages saw their payments spike to levels they couldn't afford. Mass defaults followed. Foreclosures followed. Property values crashed. In a full dollar collapse scenario, this happens faster, harder, and with less government bandwidth to intervene. Credit card debt, a slow drowning. The average American household carries roughly $8,000 to $10,000 in credit card debt. Credit cards are variable rate instruments. They currently carry average interest rates of around 20 to 22%, already extremely high. In a serious inflation environment, credit card rates can climb to 30, 35, 40%. Meanwhile, the prices of everything you buy with that card are going up. You are running on a treadmill that is speeding up. Credit card debt in a collapse scenario is potentially catastrophic. It needs to be treated as the emergency it actually is, not a permanent feature of your financial life. Student loans and car loans. Federal student loans are typically fixed rate, so the same logic as mortgages applies. You hold on to them and they become less painful in real terms as inflation rises. Car loans are often fixed rate as well, but with one important caveat: cars are depreciating assets, not appreciating ones. In a collapse scenario, the car may become worth far less than the loan on it, and the fuel to run it becomes dramatically more expensive. Transportation costs in historical collapse scenarios are among the most severe pain points for ordinary families. Part 4: What happens to your stocks, 401k, IRA, and investments? For most Americans, the vast majority of their investable wealth is sitting in one of three places: a 401k, an IRA, or a brokerage account. Mostly invested in U.S. stocks and U.S. bonds. And here is where the picture gets complicated, nuanced, and critically important. The stock market, not a simple story. People often assume that if the dollar collapses, the stock market crashes. And sometimes that's true. But it's not always that simple. Here's the nuance. If you own shares of a company, you own a fractional ownership of that company's real assets, its factories, its intellectual property, its inventory, its brand. Real assets tend to hold value even when the currency doesn't. In Weimar Germany, people who held shares in industrial companies, companies that owned physical things, actually preserved significant wealth, even as the mark became worthless. The nominal price of the stock skyrocketed because it now took billions of marks to represent the same real value. However, this is a critical however: not all stocks are equal in this scenario. Companies that have significant dollar-denominated revenues, thin margins, heavy debt loads, or whose business model depends on consumer spending power, these companies get crushed in a collapse scenario. Banks, heavily leveraged businesses, consumer discretionary companies, real danger. Companies that own hard assets, have pricing power, meaning they can raise prices as costs rise, operate globally with significant non-dollar revenue, or provide essential services. These companies have historically performed comparatively better in inflationary environments. Think about the difference between a luxury goods retailer and a company that owns farmland and sells food. In a collapse scenario, those two businesses perform very, very differently. Bonds, the disaster that most retirees don't see coming. This is perhaps the most underappreciated risk in the entire collapse scenario, and it disproportionately affects retirees and near-retirees. For decades, the conventional wisdom in retirement planning has been to gradually shift your portfolio from stocks to bonds as you age. Bonds are safer, we're told. Bonds provide stable income. And for most of financial history, that was reasonably true. But here's what bonds actually are. When you buy a U.S. government bond, you are lending the government money. In return, they promise to pay you back in U.S. dollars, plus interest. In a dollar collapse scenario, the government pays you back exactly as promised, in dollars. But those dollars are worth a fraction of what they were when you lent them. You get every penny back. It just buys almost nothing. This is called default by inflation, and it's the most genteel, politically palatable way for a government to effectively stiff its creditors. They technically never miss a payment. They just pay you back in currency that's been quietly destroyed. If you are within 10 years of retirement and your portfolio is heavily weighted toward U.S. Treasury bonds, long-duration bonds, or bond-heavy target date funds, this is something you need to understand deeply. Gold, silver, and commodities. In every major currency collapse in modern history, gold has preserved purchasing power. Not always dramatically increased it, but preserved it. An ounce of gold in Weimar Germany bought roughly the same real goods before and after the hyperinflation, even as the nominal price in marks went astronomical. Silver has historically played a similar role, though with more volatility. Commodities broadly, oil, agricultural products, industrial metals, tend to maintain real value because they represent real things the real economy needs regardless of what a piece of paper says. This is why sophisticated investors often hold a portion of their portfolio in commodity exposure as an inflation hedge. Real estate, the complicated middle ground. Real estate is a hard asset. Land is land. Buildings are buildings. And in moderate inflationary environments, real estate tends to be a reasonably good store of value, particularly income-producing properties, where rent can be adjusted upward to track inflation. However, in a full collapse scenario, real estate becomes complicated quickly. If the economy collapses severely, people lose jobs, can't pay rent, can't make mortgage payments. Property values can crash in nominal dollar terms even as they preserve relative real value compared to cash savings. Location matters enormously. Agricultural land. Properties that can produce food. Properties with water access. These tend to hold up far better in genuine collapse scenarios than urban luxury condos or commercial office space. We're about halfway through, and I want to make sure you're still with me, because the next section is where we get very real about what collapse means for ordinary daily life. Not your portfolio. Your life. Part 5, What happens to your daily life, jobs, food, energy, services. Everything we've talked about so far has been somewhat abstract. Numbers. Percentages. Financial instruments. Now let's make it concrete. What does a collapse actually feel like in your daily life? What do you experience walking into a grocery store, filling your car with gas, going to work? Grocery stores and food prices. Food prices are the most immediate and visceral indicator of currency devaluation. People interact with food prices every day. And when food prices start rising fast, it triggers social instability faster than almost any other factor. In Argentina's 2001 currency crisis, grocery store prices changed multiple times per day. Store owners would sometimes not put prices on shelves at all. You'd bring an item to the register and find out what it cost that hour. People would sprint to the grocery store the moment their paycheck hit their bank account, buying as much as they could afford immediately before the prices went up again. In Venezuela's collapse, food shortages became severe. The government imposed price controls, which sounds compassionate but actually made things dramatically worse. When the government caps the price of something below what it costs to produce, producers stop producing it. You end up with empty shelves. In a US dollar collapse, food prices would likely rise dramatically. Products that rely heavily on imported components or that are heavily traded in dollar-denominated global markets, coffee, cocoa, electronics, clothing, would spike most severely. Locally produced food, domestic fruits, vegetables, grains, would still rise in price, but potentially less dramatically if production capacity remained intact. Energy, the multiplier effect. Here is something that most people miss when they think about a dollar collapse. Oil is priced globally in US dollars. If the dollar loses significant value, the price of oil in dollars shoots up. And oil is not just for cars. Oil is in virtually everything. Employment and wages. Here is the brutally honest reality of collapse scenarios and employment: wages almost never keep pace with inflation. In every modern hyperinflationary episode, the real value of wages, what your paycheck can actually buy, collapses faster than nominal wages rise. Your employer might give you a 10% raise while inflation is running at 40%. Congratulations on your raise. You're still 30% poorer in real terms. Some industries fare better than others. Industries that deal in real assets or essential services, agriculture, energy, healthcare, utilities, tend to maintain employment better than industries that depend on consumer discretionary spending, financial services dependent on dollar stability, or import-dependent manufacturing. Small businesses, which employ roughly half the American workforce, are particularly vulnerable. They tend to have thin cash reserves, limited ability to raise prices competitively against larger players, and significant debt exposure. In the 2008 crisis, small businesses collapsed at rates multiple times higher than large corporations. Social stability and government services. This is the part that feels most dramatic, but history makes it impossible to ignore. In every serious currency collapse, social cohesion frays. Not because people become evil or savage, but because the systems that bind society together are fundamentally financial. Police departments get paid in dollars. Firefighters get paid in dollars. Hospitals get reimbursed in dollars. The entire infrastructure of modern civilization runs on a functioning currency. When the currency fails, these systems come under severe stress. Governments facing fiscal crises cut services. Basic public services deteriorate. Healthcare becomes dramatically less accessible for ordinary people. This doesn't mean society collapses into anarchy overnight. Most societies, even in severe economic distress, maintain significant social cohesion. But the quality of life, the accessibility of services, and the safety net that most Americans take for granted would be significantly compromised. Argentina went through 5 currency crises in 30 years. Life continued. People adapted. But the standard of living contracted dramatically. Many highly educated, productive Argentinians simply left for countries with stable currencies. The most dangerous thing about a currency collapse isn't the event itself, it's how long it takes most people to realize it's happening. By the time it's obvious to everyone, the best moves have already been made, by someone else. Part 6, What the financially prepared are doing right now. Alright. We have spent a lot of time on the problem. Now let's talk about what you can actually do, the moves that serious, calm, financially literate people are making right now in response to the real risks on the horizon. And I want to be clear, none of what I'm about to say is financial advice. I'm not your financial advisor. You should consult a qualified financial professional before making major financial decisions. What I'm sharing is the framework that smart, informed people are using to think about this. Step 1, get out of variable rate debt, now. If you have variable rate debt, credit cards, adjustable rate mortgages, variable business loans, eliminating or refinancing this debt to fixed rate should be your top priority. This is true regardless of whether you believe a collapse is coming. Variable rate debt in a rising interest rate environment is one of the most financially devastating situations an ordinary household can find itself in. The mathematically cleanest move for most people is to aggressively pay down high-interest variable debt before positioning in any other assets. A 22% credit card is a guaranteed negative 22% annual return on every dollar you hold in credit card debt. Step 2, diversify out of pure dollar exposure. The single most commonly cited piece of advice from financial experts who study currency risk is this: don't hold all your wealth in assets denominated in a single currency. For most Americans, virtually all their wealth is dollar denominated. Their savings account is in dollars. Their 401k is invested primarily in US dollar denominated stocks and bonds. Their home is valued in dollars. Their paycheck is in dollars. Diversification here means considering assets with exposure to other currencies, to real assets, and to internationally diversified holdings. Some examples of how people accomplish this: international stock funds with significant non-dollar exposure, precious metals like gold and silver, held in physical form or through ETFs, real estate in markets with genuine demand, commodities exposure through diversified commodity ETFs, and for a smaller, more adventurous allocation, hard assets like farmland, timberland, or productive property. Step 3, build physical resilience. This sounds old-fashioned, but it's actually one of the highest return investments you can make in a collapse-adjacent scenario: building physical resilience. What does that mean practically? It means having 60 to 90 days of essential supplies on hand: food, water filtration capability, medications. It means understanding your energy dependencies and having backup capacity where possible. It means building relationships within your local community, knowing your neighbors, having skills that are useful in low infrastructure environments. This isn't survivalist extremism. This is what every serious risk management professional recommends for household resilience. It's what FEMA recommends. It's what insurance actuaries would call basic risk hedging. And here's the financial framing of it: buying $100 of shelf-stable food today is a purchase at today's prices. If inflation runs at 30%, that $100 purchase becomes worth $130 of food security next year. That's a 30% guaranteed return on your investment in. Step 3. Build physical resilience. This sounds old-fashioned, but it's actually one of the highest return investments you can make in a collapse-adjacent scenario, building physical resilience. What does that mean practically? It means having 60 to 90 days of essential supplies on hand: food, water filtration capability, medications. It means understanding your energy dependencies and having backup capacity where possible. It means building relationships within your local community, knowing your neighbors, having skills that are useful in low infrastructure environments. This isn't survivalist extremism. This is what every serious risk management professional recommends for household resilience. It's what FEMA recommends. It's what insurance actuaries would call basic risk hedging. And here's the financial framing of it: buying $100 of shelf-stable food today is a purchase at today's prices. If inflation runs at 30%, that $100 purchase becomes worth $130 of food security next year. That's a 30% guaranteed return on your investment in emergency supplies. Step 5. Stay informed and calibrated, not panicked. Perhaps the most important piece of advice I can give you. The biggest financial mistakes are not made by people who are ignorant of risk, they're made by people who respond to risk with panic. Panic selling. Panic buying. Panic hoarding. Panic converting life savings into gold at the top of a gold price spike. Panic decisions made based on fear rather than analysis. The financially prepared are calm, deliberate, and methodical. They understand the risks, they take measured steps to hedge those risks, and they continue living productive lives. They are not terrified. They are ready. There is an enormous difference between those two states. Fear is paralyzing. Preparedness is empowering. Let me bring this full circle. We opened with a German woman in 1923 carrying a wheelbarrow full of banknotes to buy a loaf of bread. She didn't wake up that morning expecting that to be her reality. She woke up thinking her money was fine, because 2 years earlier, it was fine. Currency collapse doesn't announce itself. It creeps. It disguises itself as rising prices at the grocery store. As interest rate hikes that seem manageable. As a slow erosion of purchasing power that's easy to explain away, quarter by quarter. The people who got through Weimar Germany, through Argentina, through Zimbabwe, through Venezuela, the ones who kept their families fed and their lives intact, they weren't the wealthiest people. They weren't the most powerful people. They were the most prepared people. People who understood what was happening early enough to make calm, rational decisions. That's all this video is trying to give you: understanding. Not fear. Not panic. Not some product to sell you. Just understanding. Because an informed person is a prepared person. And a prepared person is a free person. Alright, if you made it to the end of this video, you are exactly the kind of person this channel exists for. Genuinely curious. Willing to sit with difficult information and do something constructive with it. I have one ask of you before you go. Just one. Down in the comments, right now, I want you to answer this one question. What is the one financial move you're going to make this week based on what you learned in this video? It doesn't have to be big. Maybe it's, I'm going to call my bank about refinancing my adjustable mortgage. Maybe it's, I'm going to finally start that emergency fund. Maybe it's, I'm going to buy a bag of rice and not feel stupid about it. Whatever it is, write it down in the comments. Because there is something powerful about stating an intention publicly. It makes it real. It makes it accountable. And it starts a conversation in this community that will genuinely help the people who come to this video next. If this video gave you value, if it taught you something you didn't know this morning, please hit the subscribe button. And hit the bell icon. Because I make videos exactly like this regularly, deep, research-backed, practical financial education that you are not going to get in a 30-second social media clip. And share this video. Send it to someone who needs to see it. A family member. A friend who keeps saying they're not really a financial person. This is the kind of information that is genuinely life-changing when it reaches the right person at the right time.